Hi and welcome to SolutionInn YouTube channel. In today's video we will learn about constant growth dividend discount model, commonly known as dividend discount model or DDM. But we will discuss this model with the aspect of growth in it, that is denoted by the G. As you can see, the formula for dividend discount model with constant growth in it, this is the formula. So the main components will be the dividend. We will take the appropriate rate of return to discount it, and the growth factor. So let's see what this formula can do for us. So normally the dividend discount model is used to estimate the fair market value of any share. This is the first purpose. So the basic approach that is used in this formula is that we discount the future cash flows associated with a share, that are dividends. So dividends are basically discounted to reach at a suitable present value that will be equal to the fair market value of a share. Now, to do this, we can understand that the model assumes number of factors. So first important thing is that this model assumes that dividends are expected to continue in perpetuity. This means that dividends are gonna come throughout the life, that there is no end date of dividends cash flows stream. This is the one thing. So another important assumption is that the rate of return that we are using is basically the cost of capital of the company. It remains constant. We'll discuss this later in detail, but the third factor that is very important is the growth rate remains also constant. That's why this model is called constant growth dividend discount model. Now you can see from the name that it is constant growth, because we are assuming that growth rate will be constant. One thing. And it also assumes that the dividend discount model, this discount thing is something that we are going to discount dividend cash flows at a rate that is also constant. That's the rate of return. So these three components, the dividends, the growth rate, and the rate of return, we are going to discuss these three elements in detail. So first of all, dividends. Dividends normally come from profits that company earn. So let's say a company produces goods or offer some services to earn profits, like a repairing service or something. So the cash flows earned from such business activities determine its profits, which gets reflected in the company's stock prices. So this is an important piece of information, that how your profits are reflected in your stock price. The companies that earn higher profits are retaining higher profits. So when they retain higher profits, they grow. The company grows. So does the value of the company. So the company's share prices normally increase when profits or earnings are higher. So this is a basic understanding, because this is why we are going to discount the cash flows paid out of profits or earnings to calculate its share price. There is a relationship between these two. Fine. Let's move on. The amount of dividend can be either fixed for perpetuity, or it can grow with respect of time. The companies normally have dividends announced annually. Let's say a company has paid a dividend of $1 in year 0, dividend of $1. So there are two cases: either in year 1, 2, 3, 4, throughout life, the same $1 is gonna continue, or either there is a growth. Companies can set a rate of growth based on its projections, cash flow projections, and then the cash flows related to each year will grow by the factor of 1 plus growth rate. So for year 1, we will take 1 plus G. Let's say we have a 10% growth rate. We will be multiplying this $1 with the factor of growth. This will give us $1.1. So in the year 2, we will multiply this 1 plus 10% times 2. This will $1.21, and so on. So in the year 0, we call the dividend that has recently been paid called D0. That is in the formula here, because it has no growth component included in this. That's why we multiply the element of 1 plus G to it to calculate D1. Remember, if the element of growth is multiplied once, the dividend will be for next year will be calculated. Similarly, if this is multiplied with another growth factor of 1 plus G, we will be having D2 for year 2, and so on, D3 for year 3, and D4 for year 4. So this is the basic difference between a dividend model without a growth factor and with a growth factor. In the simple calculations, when there is no growth, this element of 1 plus G will be removed. And if there is growth element in it, we will just simply add 1 plus G and subtract the growth factor from the rate of return. We'll discuss this, that why this R minus G factor is taken as a discount rate. The reason behind this is that the growth has inflated the dividend from D0 to D1. Now the discount factor should be adjusted in order to reach a effectively right discount rate. That is typically R minus G. If we discount the inflated discount dividends, with R, that will reduce the present value of cash flows. But if we adjust the amount of growth in this, it will be the right and accurate rate of return or discount rate to discount the future cash flows. So move on. The how this element of growth or R relate to each other. Normally, the companies pays, as we discussed, that dividends are paid out of earnings. So technically, something company pays out of its earnings is dividend, but not all of it. Let's assume that company earned $100 and it says that it will pay $20 as dividends. So that is something we call payout ratio. That is 20%. So if out of 100 you are paying $20, then what you are retaining? You are obviously retaining $80, and this is called retention ratio of 80%. So something that company retains is called retention ratio. Now if we want to reach a sustainable growth rate, we'll have to multiply this 80% multiplied by a rate of return that company is earning. So assuming a company is earning 20%, then the growth rate is 16%. That's pretty much higher. Let's assume a company's rate of return is 10%. Then the rate of growth would be 8%. So this growth rate would be constant because out of this 80% that company retains every year, this is constant, and the company's return on equity is also constant. Company has set its targets to achieve at least 10% every year as return on equity. So we can calculate a sustainable growth rate of 8% out of these two figures. So we have covered how dividends can be used in the formula without growth and with growth, and we have learned how to calculate the rate of growth for our calculations. The third and last part left is the rate of return, required rate of return. So basically, the required rate of return denoted by R is something that shareholders require from the company for putting their investment in your company, in any company. Because shareholders have paid for shares and company use these shares money in projects. Now projects contain risks. Project contains risk that project might fail or generate losses instead of profits. So these are the risks. Also, if a company starts a project that is made of both debt or equity. So the debt holders are paid first before any profits are distributed to ordinary shareholders. So there is another risk of being paid less. So to account for or to compensate these risks, the shareholders require a rate of return. We call it required rate of return. So this return is basically to compensate the risks taken by shareholders for their investment in the company, and it is normally compensated in terms of dividends. So the constant rate at which the company has to pay dividends is a cost of capital, cost of equity capital technically. So the R is the cost of capital that shareholders are requiring from the company against the risks they face. So we have all three components. We have learned about the D, dividends. We have learned about the growth rate. And we have now learned about the rate of return. So let's work on a thorough example to calculate how the dividend discount model can help us to estimate a stock's price. So, for example, let's say a company has recently paid a dividend of $1.8. So this is something that company has recently paid. That is why we are saying this is D naught. So when it comes to the growth rate, the company has estimated that company can attain or maintain a steady, sustainable growth rate of 5% every year. We know the calculations that how G is calculated, so we are not going in depth for that now. So assuming company has a rate of return of 7%. Now, as this is something that we want to keep in mind, that since the formula assumes that R minus G, this means that R, the required rate of return, should be higher than the growth rate. Otherwise, the formula will produce a negative value. So technically this is not possible because in real life stock prices cannot be below zero, cannot be negative. So as far as this for the purpose of calculations being realistic, the required rate of return should be higher than the growth. So with these calculations, let's apply this formula to calculate the share price that a company can offer. So share price would be D naught, that is, let's rewrite it, 1 plus growth rate over R minus G. So we have D naught 1.8 and we have 1 plus growth rate of 5%, 0.05 over, we have 7%, 0.07 minus 0.05. So if we use some calculator, the formula will give us a value of 94.5. So this value is estimated by the shareholder with the with these informations. So a shareholder who want to invest in a specific company, let's say company X. This is data for company X. So company X has offered you a share that is being traded currently at $100, that a particular shareholder compared with the value calculated using a constant growth dividend discount model of 94.5, whereas it is actually traded as $100 a share. So according to shareholder, the share of company X is overvalued. This means that shareholder will pay extra for something that is worth less. In case a company X share is being traded at $90, we'll see that a share, if you purchase for $90, has a present value or a share intrinsic value of 94.5. This is something that is worth spending. So we will say in this case that share of company X is undervalued. So this is how a shareholder can estimate a shares price to compare it with the actual amount of share, actual price of share, to make important investment decisions. So we have covered all the three elements of the constant growth dividend discount model: the dividends, where they come from, growth rate, how we calculate it, and the rate of return, what exactly shareholders expect from a company. So with the help of these three elements, we can use this formula to calculate a suitable value that can then be compared with actual market value of something, some stock. So if you have guys understood the concept, I hope you like this. If you guys have understood the concept, please mention in comments. If you want anything else to ask me about this, you can ask in comments. And I would like you to please subscribe the SolutionInn YouTube channel, and we'll see another suitable time to reach you with some new materials, some new videos on some concepts. So until then, take care. Have a good day.